Carter. Good morning, everyone, and welcome. My name is Matthew Mims from the Investment Store, and I'm delighted to welcome you to our latest webinar on sustainable and responsible investing, the Path to 2030, this time on effective stewardship. And today I'm delighted to be joined by RIAA CEO Simon O'Connor and Rachael Monteiro, who is the Stewardship Analyst at London-based WHEB Asset Management, who specialise in sustainable investing. So by way of background, today's session is going to focus on an important and integral part of responsible investing, stewardship. And I'll just show you a slide that highlights the responsible investment spectrum to show its place in that spectrum. So stewardship, including corporate engagement, shareholder activism, is becoming an increasingly prominent component of responsible investing. In fact, in its recent Aotearoa New Zealand benchmark report, RIAA identified corporate engagement and shareholder action as the third most prominent approach to responsible investing after negative screening and ESG integration. Furthermore, in September of this year, New Zealand's very own Stewardship Code was introduced. This is an industry-led code that aims to bring transparency and accountability to the practice of stewardship. So in today's session, we're going to focus in particular on the key components of stewardship, take a closer look at the New Zealand Stewardship Code, and also look at some examples of how effective stewardship can be implemented and create positive change. So just a quick bit of housekeeping. As ever, these sessions are designed for wholesale clients. As you'll know, the investment store is in the business of funds marketing, but these sessions are of a generic non-product nature. So we won't go into any product at all during the presentation per se. Today's session is going to last for about 40 minutes. And as I said at the beginning, this is part of an ongoing series of webinars that we've been running throughout the year to highlight what's happening in responsible investing, sustainable investing sectors, with the aim to highlight trends and developments in responsible investing and hopefully provide practical ideas and solutions as to how financial intermediaries in New Zealand can incorporate responsible investing into the advice process. Just a real quick disclaimer from me. I am a board member of RIAA. I've got a commercial relationship with Pengana Capital in respect of the Pengana WHEB Sustainable Impact Fund, and I did have an involvement in the development of the New Zealand Stewardship Code. So let me stop showing my screen and bring our presenters up. Let me introduce you to Simon and Rachael. Maybe just to kick off with, if you could just give us a little bit of background about yourselves, your involvement in responsible investing and stewardship in particular. Maybe, Rachael, if you could just kick off. Thank you.
Yeah, absolutely. Thanks, Matt, and thanks everyone for listening in. I'm Rachael Montero. I'm the Stewardship Analyst at WHEB Asset Management. As Matt mentioned, WHEB is a boutique positive impact firm based in London, and we focus on listed equities. I've been at WHEB for about 2 years, but the stewardship role is fairly new to WHEB generally, and has been introduced really to kind of focus on shaping the overall strategy as well as priorities and reporting.
And kia ora all, I'm Simon O'Connor, so the CEO of Responsible Investment Association Australasia. So I work with our members across the region, the Australasian region. We have about 500 investment organisation members, and really our job is to work to continue to promote and advocate and build capability in responsible investment in all its guises across that across the spectrum you just saw there. I guess I've been in this role for about the last 10 years, and what I see this area of stewardship that we're going to be discussing today is really an important evolution in terms of us actually stepping into the responsibility that we all hold when we manage, advise or own capital and deploy that across the economy, and how we think about the impact and the responsibility of how we're directing that capital. And so I guess that's a big focus for us as an organisation, working with our members in terms of how we influence for a stronger, more sustainable and prosperous future. So that's kind of what we do at RIAA.
Great, thanks, Simon. So I've got just to kick off with, I've got a couple of questions for you, Simon, probably one or two more. Just to kick off with, maybe just a quick intro to what stewardship is. And I know that RIAA's recent benchmark report highlighted the importance of stewardship. So I'll come back and ask you a question on that in a moment, but maybe just by way of introduction, how do you see stewardship?
It's a very sort of old world traditional sounding term, isn't it? But it takes us back to the kind of the core of the really financial services being entrusted to manage money on behalf of others, and how we think about the full range of tools as to how we kind of deploy that money responsibly and sustainably. And when we talk about stewardship, we usually think about how asset owners and asset managers are using way more available tools to them than merely excluding or divesting from companies from a portfolio. And so stewardship is an encompassing term that looks at the practices within investment of corporate engagement between investors and their issuing companies, voting shares, even filing resolutions, but importantly also about collaborating around big ESG issues with other investors, collaborating with issuers, and even increasingly around policy advocacy. So it's really about investors kind of using their ownership to influence for change, for more sustainable long-term outcomes through their portfolios. And I guess why it's becoming more of a focus in the NZ market, in the Australian market, and certainly other markets globally is, I guess when we think about the big issues we as economies and the world are trying to navigate, particularly thinking about climate change and the long-term need to transition our economies, it's really going to take the finance sector playing quite a different role to influence for that transition, to influence the companies we're investing in, the assets we're investing in, and it's going to require us to go well beyond just excluding a few high emissions intensive stocks or fossil fuel stocks. And so I guess stewardship becomes really important as to what we do when we own a company, how we influence that company, how we work with the boards to change strategies, and how we really take our role very seriously sitting at the table of the companies we're owning.
Yeah, I was at a conference the other day, and one of the things that cropped up is that screening is important, but if you sell your stock to somebody who doesn't care, then you lose that power of persuasion and engagement with companies on really important issues. So RIAA's recent benchmark report highlighted growth and trends in stewardship as a component of responsible investing. Were there any particular conclusions that you drew from that the benchmark report?
Yeah, we did indeed. And I think what we're seeing is an industry, a responsible investment industry that's getting more sophisticated and better at using the multiple tools we have available to us to influence for change, to manage for risk, and to ensure better outcomes for our members and beneficiaries. It was really interesting to see this continuing stepping up of activity in the corporate engagement space. We saw a lot more investment organizations issuing stewardship reports or engagement reports, or being more transparent about how they're voting, their voting practices and outcomes. We're also seeing a subtle shift whereby the reporting and disclosure is not just about the activities that investment organizations undertook, i.e. we engaged with 73 companies and we voted all of our shares, but also about the outcomes. What did we manage to achieve? What are we aiming to achieve? How successful were we at achieving that? And this is a really, I guess, a trickier area, but one that we're really seeing an evolution in that sort of reporting and disclosure, and holding investment organizations themselves to account to actually talk about what they're doing with that ownership responsibility they have. So, so that was a really significant shift in the NZ market, and a really important and timely one, I guess.
And we've both been involved in the development of the Aotearoa New Zealand Stewardship Code that was launched at the RIAA conference a little over a month ago. Maybe if you could just talk us through the background to this and what some of the key components, principles are.
Yeah, well, Rachael would well know that other parts of the world have long had stewardship codes in place, particularly the UK, and its absence has been, I guess, a gap in the financial services kind of market context in the New Zealand market. And so I think that was highlighted a couple of years ago through the Sustainable Finance Forum's roadmap for New Zealand. And a key recommendation of that was the need for a stewardship code in the NZ context. The reason for a code, I guess, is it articulates what good looks like, what it really codifies and provides guidance for what is expected in terms of good stewardship practices, and gives a framework against which investment organizations can report back and disclose on an annual basis. And so I guess providing that sort of framework and standard, in a sense, is really important to guide the market as to what good practice looks like and what's expected. And so there was a lot of work by the industry in New Zealand over about 18 months, including ourselves, Matt, but really good collaborative work to build and create a code for the New Zealand market. And we looked really carefully around the world. And I think what we saw is the UK code and some recent updates to the UK code really were, in our view, the strongest in terms of guiding investors around the management of long-term ESG issues and really looking not just at a stock-specific kind of stewardship practice, but also at that system-wide kinds of issues and the need for investors to think about their role in grappling with the big system-wide challenges that are impacting portfolios. And so it was really great to have that launched recently in September. We have a number of founding signatories in place and more coming, and we're working with a whole lot of the investment market to do that, to really set up and codify what good practice looks like. And what you'll see in the coming years is more and greater disclosure and reporting from asset managers, asset owners, KiwiSaver providers on how they're doing stewardship, what that looks like and what they're achieving through that.
Great, that's great. Could you maybe just touch on one or two of the principles within the code?
Yeah, so there are things in there such as the need to collaborate, the need to consider ESG issues, the need to think about your engagement practices, the need to disclose and be transparent on what you're actually doing there, and even the need to be kind of having those basic policies and practices that underpin the activities. And so it kind of sets out quite clearly, you know, what's expected, what stewardship includes, such as engagement, voting, collaboration, policy advocacy, considering ESG issues, considering system-wide issues, and then give some guidance as to how you disclose and report on that.
Great, thank you. So Rachel, the UK's had a stewardship code for quite some time now. I don't know if you could make some comments, like how's it gone, what's the uptake been, how effective has it been in lifting?
Yeah, so the UK's had a code since 2010, so for quite a while. It was revised slightly in 2012, pretty much left untouched until 2020, and really that was because the renewed code was introduced off the back of some criticisms that it faced previously, where it was really just focused around what are asset owners and asset managers policies for stewardship, whereas, as Simon mentioned earlier, the focus really now is shifting to what are the activities and what are the outcomes of those activities for effective stewardship. And I think the uptake has been fairly good. Last time I checked, I think we had about 230 signatories, just over 230 signatories, which is about 40 trillion in AUM, and the approval rate is somewhere between 65 to 70%. So the bar is quite high in order to become a signatory, but it also shows that there is work still to do to kind of lift the standard of stewardship in the UK. That being said, with the code being introduced in 2020, the FRC, so the Financial Reporting Council, who's the body who kind of govern and administer the stewardship code in the UK, have collected about 2 years worth of data now from the reports, and there is pretty strong evidence to suggest that it has been an important tool for increasing governance and resources for stewardship, which is really important for actually integrating stewardship, so the engagement and the voting into investment decisions. That it's enabled and put greater emphasis on collaborative engagement, again, which is something else that Simon's just mentioned, and that the additional reporting requirements have provided an opportunity for asset managers to kind of reflect on what's working, what isn't working, to improve processes, and given a bit more of a voice to asset owners to kind of delve further than simply just the managers' policies. So on that basis, you know, the initial review kind of shows that it has been successful in driving market expectations and contributing to industry-wide change, but nonetheless, next year, 2023, the pensions regulator is looking to do a full review of the new code, and we'll probably be making a decision off the back of that review whether or not to introduce any further regulation in this area. and on that point, I should probably mention that, you know, the code in the UK is still voluntary and it is still administered on a comply or explain basis.
Sorry, WHEB's a global investor investing in global equities. Are you seeing, as a global investor, are you seeing anything, any trends globally in terms of stewardship, improvement in standards at a more global level?
I think on a global scale, what we have really, and part of my new role as the stewardship analyst, is really trying to think about a kind of higher level and away from the day-to-day, but you know, what can we be doing to increase the effectiveness of our stewardship? And I think there's a need to recognise really kind of the nuances and differences between different jurisdictions. You know, we can't apply the same policy really. For example, when it comes to our voting policy, WHEB has quite a demanding policy when it comes to, for example, gender diversity. We can't really kind of apply the same broad brushstrokes with every kind of all of our issuers across all jurisdictions, and really have to kind of take more consideration of, you know, the kind of different cultural differences between various countries. And I think that's probably one of the main things that we'll be doing with our stewardship generally, and kind of hope to be doing in a collaborative sense with others as well.
So for an investor like WHEB, how important is stewardship to you?
I think, well, for WHEB as a positive, you know, being focused on positive impact, stewardship is really important for us. It's a pretty essential component of what we see as our contribution to positive impact. We see our role as kind of providing support and encouragement to investee companies, and part of that is obviously the direct investment itself, but also the work that we do directly with the issuers, and also on a broader sense in terms of public policy, as Simon mentioned before. But it's also really important, I think, for managers who, you know, don't necessarily have quite a stronger an impact focus. Stewardship, in essence, is a way of kind of gaining additional insights into the companies themselves, and really, in order to kind of manage money in the best way possible for savers and pensioners, those insights should really feed back into investment decisions.
And when you're looking at companies to invest in, how would you, I mean, what sort of 3 or 4 key things would help you or lead you to define good stewardship?
I think for us, good stewardship is really effective stewardship. And again, this kind of, for us, it's more, you know, we're a tiny team, right? So we really need to be kind of pragmatic and think about how we're focusing our efforts. And so in order to be effective, we really need to look at what are the material issues for the company in question. And of course, there are some topics that come up as a kind of trend across the strategy or more broadly in the market, such as net zero or diversity. But really for us, it's looking at, okay, what are the key issues that are presenting risks or potentially opportunities for some of these companies, and how do we really work with that business or potentially with you know, other investors to collaborate and drive you know, drive our agenda forward, looking at objectives that we could set with them, be that around kind of fact finding or disclosing more information, and then that kind of eventually leading to behavioral change. And the key thing to do there really is to start and boil down with, you know, what are the key material issues that we should be focusing on, because we can't, sadly, we can't, you know, engage with all businesses on all topics.
Yeah. Can you provide us maybe 1 or 2 examples of where the stewardship policy has actually led to positive change and positive outcomes?
Yeah, I think back on the topic of net zero, we've had a real push across pretty much all of the strategy, but with a particular focus on, you know, the kind of worst offenders. But we had a push on net zero carbon commitments for all of the companies in our strategy, in line with the commitments that we've made at the portfolio level, and as a business as well. And I think when we started this journey back in 2019, about 98% of the portfolio didn't actually have a net zero carbon commitment. That's halved to today, and 44% So I think we've got about 42% of investee companies have now got net zero 2050 targets. Further 11 have got 2030 targets in place, and so we're doing plenty of work with them to kind of develop strategies further. A specific example would be work that we've been doing with Daikin, so HVAC manufacturer. They are or have been identified by the CA 100, so Climate Action 100 Plus, as being a particularly bad offender. WHEB has contributed quite heavily to engagements, collaborative engagements via the CA 100. And over the course of the last 2 years, we've been successful in encouraging Daikin to, first of all, set a net zero carbon target, but then also to develop the strategy that actually underpins that target. And that's something that's still ongoing today.
That's great. So when you measure the impact of stewardship, obviously, perhaps with a metric like carbon zero and carbon intensity, it's easier, but have you maybe got another example of how you measure the stewardship?
It's a bit of a tricky one, right? So we generally gauge whether or not, but the first thing is we need to set an objective in all of our engagements, and we have to be really clear in that. And when it comes to reporting against a stewardship code, being really clear in what the objective is will definitely be something that's helpful for those reading the reports. But once we know what the objective is, we can kind of determine whether or not we've been successful in achieving that. So we judge our engagements as being successful, i.e. the objective is achieved, partially successful where we've heard back from the company, so we know that they are kind of engaged on the topic or with us, and then unsuccessful where we haven't heard anything at all. And it's really tricky for managers like WHEB to kind of directly attribute any outcomes to our involvement, but we have this nice analogy that I'm probably about to butcher, but I'll give it a go anyway. Which is that, when you're, if you're a football or a rugby fan in the crowd singing and cheering along for your team, it's really difficult to say that you were the person who kind of, resulted in your team's direct success, but your voice along with all of the others around you is really contributing to that kind of collective action. And that's really what we want to think that we're doing when we say that our engagement has been successful.
And I suppose the age-old question around financial performance, investment returns, do you think that effective stewardship has led to better financial performance, or can do?
In the long run, we know that improving certain ESG metrics, material ESG metrics, can improve financial performance. And so where engagement and voting activity is centered around improving material issues for the company in question, then yes, absolutely. In terms of financial performance for WHEB, so we really look at our investments where, in terms of kind of, the impact story, the positive impact story being tied to the equity story. And part of the engagement that we do as a positive impact investor is really around talking to some of our companies and encouraging them to kind of increase the positive impact associated with their products and services. An example of that would be, we've had conversations with JB Hunt recently, encouraging the company to kind of roll out EVs in their intermodal transport services. And so, where we think, as we say, the impact story is the equity story, we think there's a real opportunity there for financial performance to increase further down the line with our engagement efforts.
Thank you. So Simon, for our audience today, if you're a financial advisor or an investment consultant, or even an investor, why should stewardship be relevant?
Yeah, I think there's a number of things here. I think this is another way that advisors can sort of assess the quality of the managers they're talking to really understand whether those managers are taking really using the full influence they have to ensure and underpin longer term outperformance, to better ESG outcomes, better sustainability outcomes. And so I think what advisors will see is a lot more reporting and disclosure from managers around stewardship, and we'll hear a lot more of these stories as to how managers are using their ownership to influence companies to change behaviours. And I think that will make a much richer and nuanced conversation between advisors and managers. and also allow advisors to kind of distinguish between managers who, I guess it gives another way to assess a manager beyond just what's in the portfolio and what's not in the portfolio. And I think we've had a very blunt way of assessing managers in many ways to date by saying, okay, there's a bad company in your portfolio, therefore that's bad, and I think we need to move beyond that very rapidly. That this whole area is going to take a whole lot more sophistication than just excluding a few sectors and a few stocks to really create an economy, to create companies, to create portfolios that are going to outperform through these coming decades. And so I think from an advisor, it's a great way to start scrutinizing managers and understanding what they're doing, and interrogate these stewardship reports and disclosure. So that's more information, more nuance, more detailed sort of way of assessing. I think on the flip side though, what probably has been less explored is what could advisors do in terms of engaging in stewardship themselves or with their clients. And we are starting to see some wealth management firms or advisors engaging with their clients to actually direct voting, for example. So one of the outcomes of stewardship is a whole lot more ESG-based resolutions being put up at AGMs around the world. So, and investors then can thoughtfully direct their votes on that. And we are starting to see wealth management firms and advisors working with their clients to say, would you actually like to direct your own vote on this climate change resolution being put up at this particular company, or a diversity resolution, or a remuneration resolution? And I think we're starting to see that a little bit. We are also starting to see within our membership of advisors, some that are actually working collaboratively with investors to put up resolutions, to file resolutions at AGMs, and to be some of the shareholders that are helping to put those resolutions forward. And so this is another outcome of stewardship, is that we're seeing more investor filed resolutions around big sustainability issues. Just this week, early the month of November, we've seen a really big shift at the major energy fossil fuel company in Australia, AGL Energy, whereby we just saw 4 new directors voted onto the board there, who were put forward by effectively climate transition advocates, and were supported to be put onto that board against the wishes of the company and the board, who had not been adequately really taken into consideration a climate transition for what is the largest emitting company in the Australian economy. And so there'd been a whole lot of pressure, a whole lot of the big institutions had come in behind that change and that push for the company, and have ultimately successfully put forward new directors who know about energy transition, renewable energy, onto that board. So this is kind of an outcome of the stewardship process. And I guess advisors as well have the ability to influence, in certain circumstances, to influence the direction of their voting and their shares. So, so I think it can deliver a really rich and nuanced conversation with a manager. And there's a million ways you could do stewardship, as you heard from Rachael there, and there's a million different things you could prioritize, and there's no way any investor can do all of them, for example. So I think that conversation with your asset manager, with your KiwiSaver provider, even in the context of your directly held shares, I think is a really interesting one for us to start really thinking on what is our responsibility in terms of influencing these companies we're investing in around big sustainability issues.
Yeah, I think it's worth pointing out that the New Zealand Stewardship Code, whilst voluntary, like the UK Code, does capture discretionary investment management services. Sorry, Rachael, it's a technical point, but DIMS providers, a lot of advisors will run DIMS services for their clients. Yeah, there's some strong relevance there. Couple of questions before we finish up. We're just picking up on the point that Simon made, Rachael. Do you find that any of your unit holders are quite vocal and engaging with you in terms of some of the companies that you own, and have strong views around that sort of stuff?
So in terms of engagement with our end investors, yes, we have a couple of institutional clients who are really quite progressive in their thoughts, and we do a lot of work with one particular local government pension fund to kind of compare notes when various resolutions come up, and kind of think about how we can drive our kind of ambitious agendas. I think it's definitely something that we want to do more of. I think being able to kind of empower unit holders to kind of enact their values through their votes is something that's really important. And part of our role as stewards is really to kind of report back to them on what we're doing. I think the point that Simon made around kind of storytelling through kind of case studies on what we're actually doing, that will just kind of, I think we can't really underestimate the value of kind of creating that emotional connection for the investors with their investments and their savings, basically, and kind of the powerful, how powerful that can be in comparison to just kind of shoving a number of stats and figures at them that they kind of make no sense to them, or don't make the same kind of emotional connection for them as those stories do.
Great. And so the really final question is a bit obvious, I guess, but it's just looking to the future and how you see potential developments in stewardship going forward. So maybe Rachel, if you could kick that one off.
Yeah, definitely. I think kind of on a more global scale, as mentioned earlier, there are a number of global stewardship codes. Some of them have been in place for a little bit of time. I think as they get renewed, we'll see more focus on activities and outcomes reporting, which can only be a good thing. And hopefully, in the UK, we're seeing a fair amount of interest from retail investors through platforms like Tumalo, which enable people to kind of vote their shares or to express the wish of how they would like their managers to vote their shares come up. And so hopefully we'll see a lot more connection between the end investor and the investments themselves through stewardship.
Right. And Simon, in terms of the New Zealand context?
Yeah, well, I think investors in many ways are just still sort of sharpening their tools in this area and getting better and more organised. And so I think what it will see is we're likely to see more resolutions being put forward, more vocal kind of views of investors on the ESG and sustainability strategies of companies. I think collaboration will continue to expand. Climate Action 100 has been a really great example of very effective collaboration between investors and companies and has driven a lot of change. And I think that New Zealand has a history of that kind of investor collaboration too. The Christchurch call was a huge one that New Zealand drove on a global basis in terms of the influence in social media companies to limit, the way they're publishing offensive content online, for example. And so I think we will only see more of this. The types of issues we're trying to address here, which are really kind of existential in many ways, are going to require investors to get more organised around this. And so my hope is that it shifts the conversation in New Zealand from one that is focused often really strongly on just who you're invested in and who you're excluding from your portfolio. I think what becomes more important is what are you doing with the companies you're invested in and how you influence in those companies, as opposed to just who are you avoiding. Because as you said earlier, really the need to have a seat at the table to influence those companies, to drive the transition that we need, to maintain a sort of prosperous and thriving economy and society and environment is going to be essential that investors play a critical role there. So I think we'll see a lot more activity in this space in New Zealand and globally.
Thank you. I think that's been great. Thanks very much to Rachel and Simon for your time today and for sharing your insights in terms of stewardship. Appreciate it. It's early in Australia and it's getting late in London, so very much appreciate the time and effort you've put in. And thank you for everyone dialing in today. Hope you found it enjoyable and worthwhile. We'll send a follow-up note out shortly with a few relevant links, and we will continue to run these webinars on various subjects over the coming weeks and months, and we'll advise you in due course. But many thanks and have a good day.